You shouldn't have been surprised to see the market sell off like this. I have been giving you day after day, warning after warning that something bad was coming. And when Nvidia popped up in the morning, people lost their minds saying, oh, here we go, we're back to normal. And then Nvidia sold off by the end of the day. Look at this big, ugly, nasty red candle on Nvidia, which was already in a downtrend. And now the market just took it on the chin, right? But we have been telling you for a while to get out of the way, get out of the market, sit in cash, and don't F up your portfolio. That is not fiction. That is not something trying to be funny. That is my way of telling you the best trade that you can make is to hold cash because the market's not working for you. Now, how did I come across to this? First off, we had a sell signal on November 14th, which was this candle right here. Second off, within 1 day later, the 10 went under the 20 and price went under the 50. That is a bearish trend. Now, bearish trends can absolutely turn around and resolve themselves. But in the meantime, you don't want to be the person to find out how much lower this bearish trend is going to go before it stops. Now, the 10 EMA, the 20 EMA, and the 50 EMA, you've heard me talk about it before. I'm a broken record. I know, because it works. Because it always works. Because it's math. I can say that without any sort of disclaimer. I can say that unequivocally speaking, that this always works when your short-term moving average is over your intermediate-term moving average and your price is over your long-term moving average. You are in a bullish trend. And the same is true the other ways. When the 10 is under the 20 and price is under the 50, you are in a bearish trend. Now, the thing that we don't do around here is make predictions, because I'm not telling you, I predict the SPY to go from 650 to 600. I predict the market to go down 25%. I don't do predictions. I don't need to do predictions. All I need to know is which direction is the market trending. I'll ride that trend as long as I possibly can. And then when it starts to bend, you get out of the way. So I know you've heard me say it before, but you know why I like to say it? Because it works. Hashtag Outlier, because it works. Dean's saying right there, yesterday was brutal. Marketers seem to use the news to squeeze out of retailers. Sure, absolutely. But the point is that you had warning. You had all the warning in the world. You had at least, so this was last Friday. You had at least 3 or 4 trading days before the big nastiness started to happen. I'm here for you. I don't have to do this. I could disappear and go away forever. I don't have to do this at all. I choose to do this because I love the game. And I'm trying to teach you everything you need to know for the game as well. So let's take a look at some of your questions. So Break Beating says, can someone show me where to import the TradingView scripts? It's actually super simple. So inside of our Discord, there's lots of channels, including the memes channel, which is one of my favorites. Hey, Nvidia popped up on earnings and it's gone. All you have to do is go over to the channel called FAQ and member contributions. I have that saved as a favorite. You may have to scroll around to find it. FAQ and member contributions. And here, there's a section called TradingView. Click on the TradingView section, and it's going to pull this up right here. All you got to do is click the indicators that are shown right there. The 2 most recent ones are the ones you're looking for. You can click it, and it's going to pull up a new screen. On that screen, you can go add to favorite or remove from favorites. Once it's here, it will show up in your favorites in TradingView. There it is right there. Right? And then it's enabled, or you have to turn it on to enable it, and then you got it. Easy peasy. Now, what's cool about that is a free indicator that we use inside of Outlier. I'm using it right now. And it'll allow your charts to look exactly the same as mine. And you can use the free TradingView plan to do this, because the free TradingView plan gives you 2 indicators. We've built, Deep Thought, one of the smartest people that I know, has built the indicator to have all kinds of sub indicators inside of it. That way, with the one free indicator, you can have the one free plan with TradingView and have all kinds of great stuff. Now, I'm bougie, I'm fancy, and I have the mid-tier plan for TradingView. I don't know what it's called, but either way, you can do this for free. So great question. KD Castle says, do options of the same delta strike but different expiration move the same or different due to potential IV of different strikes? Ooh, that's a deep question. Okay. So I may not have the perfect answer, but I'll give you the best answer that I possibly can. So let's, when you say same delta strike, but different expiration, I assume you mean same delta, but not necessarily same strike. We can look at it from a couple different directions. So SoFi Bros Unite, we'll use SoFi as an example. SoFi for life, it only goes up. Let's look at the 80, we'll use this one right here, the 79 delta for SoFi expiring on December 28th. We'll look at the 80 delta, roughly 80 delta for SoFi expiring on November 21st. And then we'll look at the 80 delta expiring April 17th of next year. So 80 delta is roughly right here. Okay, so all three of these from here, here, and here, right? All of them listed down here. They all have roughly 80 delta, maybe one or two different, but roughly 80 delta. 80 delta means that for every $1 move in the stock, the option price will increase by 80 cents. That's what the 80 delta means. Now, this one over here, this costs $2.24. This one over here costs $4.85. And this one over here costs $9.20. Now, the difference in all these has to do with how deep in the money they are and how much extrinsic value there is. So let's start over here. Extrinsic value. Remember, this is the part that will decay to zero no matter what. And this one will decay to zero today. Okay, it has 20 cents of extrinsic value today. And it's the 23 strike, meaning it's roughly $2 in the money, which is why the intrinsic value is roughly $2. We go to here. This one is the 21 strike, which means it's roughly $4 in the money, which is why it has roughly $4 of intrinsic value. But because it has more uncertainty value, the extrinsic value, that's why it goes to 82 cents. Remember, the one over here was 20 cents. The one here is 82 cents because it has that much more uncertainty, more risk associated with it because there's more time. And then we go out to April and we can see this one is the 18 strike, right? We went deeper in the money each time to get the same level of delta, meaning they got more valuable on the intrinsic value, but they also cost more in our extrinsic value. Remember, the middle distance one was roughly 80 cents. This one is $1.61, so it has twice as much uncertainty value associated with it, still right at the 80 delta. The point that I'm trying to get at here is that they are all the 80 delta. Every single one of them is the 80 delta, meaning no matter which one of these you choose, it will still move 80 cents for every $1 of the stock movement. The price of the option will move 80 cents for every $1 of the stock movement. So in theory, you could pick any one of these. Now, which one should you pick? That's a great question. You're going to have to build that into your trading plan. But for me personally, like we just talked about, right? This one that's 147 days out has $1.61 of extrinsic value. This one has 82 cents of extrinsic value. So there's half the price right there that you have to pay for extrinsic value. I would never trade a single day option. Never, ever, ever. So you've got basically half the extrinsic value. Now, this one also costs $4.85 total, where this one costs $9 total. So it's basically half the price because it's half the distance in the money. So for me personally, this is where I would go. You're going to get the same movement, the same 80 delta movement, but it's going to cost you half the outlay in capital, right? Half the margin requirement to get the same, to basically get the same result. Now, 28 days, my general rule of thumb is to start at 21 days. Why? Because the trades inside of Outlier, the rough average trade duration is 17 to 19 days, which means in theory, I could buy an option, never touch it all the way to expiration. I wouldn't do that, but just for example here, and it would still encompass the entirety of the open to close. Right now, if I need to roll out in time, no problem. If it gets down to where, you know, I'm within a week, I'll just roll it out. And by rolling, I take in credit, I reduce my risk in the trade, and I keep the trade alive. So it's a great question to kick us off, KD Castle. Really appreciate you. Steve says, with the new plans, M&A, if after a roll or two, would the -2 and -3 ATR stops be moved up? No, they wouldn't. That's a really good question, but no, they would not. Let me pull up the exit signals for those guys real quick. So you can get this exact PowerPoint on our Discord. In fact, I'll show you where it is. You go into the FAQ and member contributions, Outlier trading plans. There's your link right there. Boom, easy peasy. So looking at this, plan and exit signals. This 2 ATR stop is from entry. This 3 ATR midday emergency exit is from entry. These are our stop losses. Everything else is what's called a trailing stop. Let's talk about the difference between a stop loss and a trailing stop. Let's say, for example, that we entered right here, right? Let's just say, for example, we entered right here. A stop loss is put below your entry price here. Okay. Stop loss is where you're going to lose money. A trailing stop, we'll just do, we'll do a blue line. A trailing stop moves up along with you, moves up along with you. Okay. Stop loss, trailing stop. Both of these will get you out. Now, in this case, we're not using a defined trailing stop right here. We're using the market to tell us first a sell signal, second, a 10-20 bearish cross. That right there is your trailing stop because as you can see, it can move up the whole way. And then this is where it crossed over. Okay. If it runs into an outlier block, any earnings, and any gap in craps. And the plan A, very, very similar. This one is just closing under the 10 EMA, where plan M is using the 10-20 bearish cross. A little bit different, but very similar in execution. But to answer your question, no, the -2 and -3 ATR stops are stop losses, and therefore they stay where they are. And then we move to trailing stops. Good question, though. Dave says, is there a way to set up the dashboard to receive alerts when all 9 are hit on stock? So as of right now, no, but that is coming soon. I know for sure Mahesh is building that into the screener. Now, it's going to be as simple as, because he and I worked together on this, I said, I want to have a all 9 button. If Outlier 9 is active, tell me. That's what I want to see. And then you'll be able to see all of them that are active at that moment. What's cool about that too is rather than waiting for an alert, right? Let's say the buy signal comes a week ago, and then the trend changes, and then you get your outlier channels and everything else on lining up. Then it won't show up until the day that all 9 are set up. You click the button, then it will show up on here, and then you're like, oh, okay, cool. I didn't have to watch it for a week waiting for it to get to the all 9. It just pops up inside of my my screener all at once. So that's coming soon. I can't tell you when, but I know it's coming soon. Breakbeaten says, what's the name of the option chain broker you use on the show, and is there a discount code? Okay, good question. So we use TradingView. Now I will be using this exact account, which I still got to send Mahesh the information. We're funding it with $50,000. Trade.trader.com/outlier, and this will be the exact account that I'm using to place in the U.S. Investing Championship with all of our outliers. And every single trade that I put on will be live on YouTube. If you are an outlier, you'll be able to watch it live. If you're not, you'll see the replay. And every single trade that I put on in the US Investing Championship next year will be inside of here in the Outlier trading room. And every single trade I put on for years is in here as well, right? Transparent as transparent can be. Now, that broker is trade.trader.com. What's really cool about this is if you sign up and you're an outlier, you'll get 6 months of 0 commission trades. That's pretty baller. And then $150 reimbursed by TradingView into your account when you open an account with at least $3,000, right? Sounds like an ad. I don't care if you use it or not. Use whatever broker you want. But hey, there's a handsome guy right there. But we do have a good partnership with them, and it's going to help you out a lot if you are looking for a new broker. Let's keep going. Outline. So Neil, outline the best strategy for an in-the-money call buying in detail. First off, this is questions, not demands. How dare you not ask politely, Neil? Mainly selecting expiring date, exit strategies also. Okay. Clearly this is a very long question / statement / demand, but here's what I'm gonna do. For me, I'll just show you my screens. What I'm looking for is 21 days to expiration. That's my starting point. I'll go closer or further out as needed. So for example, if we're looking at SoFi, I would start here. Now, I would go not on this strike because there's not much liquidity over here. One of my criteria is I need to see at least 250 open interest. I don't have that here. So I would go closer. Don't really see it over here. But if I go further, lots of liquidity. Okay, I'm going to trade this guy. Next, less than 50-cent bid-ask spread. Now, the market's closed right now by the time we're watching this, so the spreads are going to be a bit wider. But when I'm looking at this, I'm looking to see, okay, lots of liquidity, open interest here, and maybe this one, right? It's 25 cents wide, which is still pretty wide for a $20 stock. Okay, all right, I'm interested. 30% absolute max on extrinsic value. When I say absolute max, I mean if it's 30.01, I will not take the trade. Now, I prefer 20% or less. That's really my wheelhouse, but I'll nickel and dime it out to 30%. So if I'm looking at this one right here, how do I calculate that? It does involve calculating, okay? You would take your 82 cents of extrinsic value, because remember, the extrinsic values are uncertainty value, and it will go down over time. You divide it by the ask price, right? You're not going to divide it by the bid. You're not going to divide it by the mid. You're going to divide it by the ask, because that's the worst price you're going to have to pay for it. And that gives you 16.9%. I love that. That is perfect. That is exactly where Chris wants to live. If it, let's show you a different one over here. Like, let's go with $1.80, right? 1.80 divided by 275. That means 65%. That's crazy. 65% of this option will decay. I don't want that. I would much rather have 16% versus 65% decay over time. So that's why I would choose the 21. Let's keep going. The goal is 20% or less, but no more than 30. That is the uncertainty value that will decay over time. And generally, what makes it really easy is if you just look for the 80 delta call, most of the time, you look for the 80 delta call. A lot of times, this is crazy too, you'll see a spike in volume right around the 80 delta. Don't ask me why, but that's where a lot of traders go. And then you look over at your extrinsic value. So it can be as simple as pull up any one, look for the 80, look for your open interest, and then do a quick calculation. $1.61 on 920 is 17.5%. That's cool, except this is really, really wide. Why do I care about that? If it's $9.20 to buy it and $7.85 to sell, you're going to lose $1.35 for the privilege of opening and closing the trade, which is a loss of 14. Let's round it up. You're going to lose 15% of the options value just to open it, to close it. Screw that noise. No, thank you. That's why we keep our bid and ask spreads really tight. Buy what dip? I need some chips. Yeah, don't be buying any dips around here. Okay, here's the deal. There's going to be people on YouTube. I'm telling you right now, there will be people on YouTube who are screaming today, you've got to buy the dip. I don't think you understand. Today is the greatest day ever of all time to buy the market because it always goes back up. The issue here is that it may go up in the future. Absolutely may. But we don't know how far down it will go and for how long. Okay. I want to use an example from the COVID crash. You're going to like this. In the COVID crash, right? So this is in 2020. The first day, it was the 10 under 20 price under the 50 was right here. Okay. That was Monday, February 24th. If you were following the outlier trend template, you would have been out because you said this is a bearish trend. I don't know how long it's going to stay this way. So there are other people who are going to tell you buy the dip, buy the dip, buy the dip. Now, let's say that they did buy it right here, but you're smart, you're an outlier, and you waited for the 10 over 20 price over 50, which is right here. Okay. By the time this person gets back to break even, that is from February to June, you are already up 15% in the trade. By the time this person who bought the dip is back to break even, you are up 15%. And you're almost to profitability immediately. Now let's look over here in 2022. If you thought that was bad, just wait till you see 2022. Let's say that you heard somebody say buy the dip and you didn't know exactly how far it was going to go, right? So you bought the dip right here and you held it and you held it and you held it and you held it and you held it. You finally got to break even in December of 2023 from January of 2022. So basically 2 entire calendar years. In fact, if I move this back a little bit, December 2021, 2 entire calendar years to get back to break even if you bought the dip. However, if you were using the trend template, you could have got in, out. You might have made a buck or lost a buck. In, out. You might have made a buck or lost a buck. In, out. You might have made a buck or lost a buck. And then you'd have made a good bit of bucks right here. Let's see. Here to, from here to here, roughly 11%, while that person's still waiting to get back to break even. You'd have been out of the way. And then you could have done it again and made another 7%. So basically, you add those two together, you're going to get roughly 20% gains, while this person who wanted to buy the dip had to wait 2 years to get back to break even. And that doesn't even include all the little bullish runs in the meantime. Pretty cool, right? Pretty cool. Don't be buying dips. Buy stocks as they're crashing up, not as they're crashing down, because you just don't know how far down they're going to go. What's the latest with meeting up with the author? Oh, okay. So Leslie, what's his face? Leslie, this book right here. Leslie Masonson. Yeah. So he emailed us. The truth is I kind of dropped the ball on that one. His email is still sitting in my inbox. Maybe it'll happen. We'll see. That's 100% on me, by the way. Hi, Chris. New here to the channel. Where can we find the trading plans in the Discord? Oh, I just showed you that, but I'll show you again. Inside the Discord, which to get into the Discord, you just come over here to the right-hand side, click the little Discord icon, pulls you up in the Discord, go to the FAQ and member section, and then you'll see Outlier Trading Plans, MA, ETF, and Sit in Cash. There you go. That easy, my friend. Has the market top, bottom fallen out of the market at this point? I don't know. I don't know, right? This is not one of those channels that makes predictions. But all you can tell right here, Mr. J Dunn can Android? Mr. Android, all you can do right now is what everybody can do, which is observe what's happening right now. Nobody besides Nancy Pelosi has the right-hand side of the chart. And because of that, all we can do is say, okay, right now, what I can see is the 10 is under the 20, price is under the 50. This is a bearish trend. When will it reverse? I don't know. Is this the top for the year? I don't know that either. And I don't have to know. All you have to do is recognize which way it is trending, use the data that you have in Outlier to help you determine which direction it's going, like market breadth right here. Let's pull up market breadth because I want to show you this. There are absolutely no bullish sectors for market breadth. Zero, not one. Every single sector has bearish market breadth, meaning more and more sell signals, less and less buy signals. Today, 104 new sell signals, 15 new buy signals. And that plotted looks like this. Also down here, you'll notice this gray bars versus the green and black, green and red bars. Very Christmassy bars. You'll notice what this means right here is that there's less and less uptrends and more downtrends, right? Market breadth is terrible. The market is in a bearish trend. There's not a single sector with bullish breadth. There's nothing to buy right now in a market like this. The best trade to make is sitting in cash and not effing up your portfolio. Now, we sit in SGov because SGov pays roughly 4.3% annualized. And that means while the market's going down, you actually get paid on a daily basis, daily interest in SGov. How cool is that? How cool is that, right? You don't have to try and time the market on the way down. In fact, I don't plan to trade any short trades, not any whatsoever. Just going to be sitting in SGov. That easy. When will Lucy be back? I don't know. I saw Lucy last week. She's so cute. For those of you who don't know, Lucy's this little bitty tiny fluffy dog. And she was on the channel for a hot minute while we were doing some dog sitting. And she's not my dog. She's a friend of ours dog. I don't know. Maybe Lucy will make a guest appearance. I don't know. Mr. Lubrador says, what would be the reason for someone to buy a call option on the day of because they're gamblers, because they're degenerate gamblers, because they look at the market and they say 0 DTE options, let's go. I don't have to pay anything for this option, right? So I'm not joking. That is the reason. They're degenerate gamblers who don't understand how the market works. When you are going deep in the money, which is where I go, and you have a trading plan in place with a statistical edge in the market, like Plan M has an edge of 2.25%. Plan A has an edge of, give me a second here, has an edge of 1.22%. Plan ETF shows a backtested return of 1,140% over 5 years. None of that involves 0 DTE options. A degenerate gambler buys 0 DTE options because it's one of the two options: out of the money or in the money. It is exactly akin to walking into the casino, putting it all in black and saying, all right, let's do this thing. Do not do that. I mean, granted, if you're a DJ and gambler and that's what you do, by all means, you do you. I don't care. I don't care at all. But if you are a investor who wants to take an investment that already has value, like an in the money call, and you want to become more valuable, then you don't do that. Now, I will say this. There was a point in my life before I actually was making money where I would go to SPX, which is the S&P 500 index. and I would sell a put spread on it. So for example, and I am not telling you to do this. I would hate for you to do this. I would sell, for example, like a 20 delta spread. So let's say here to here. In this case, the most that I could possibly make, I don't know why it's going so slow. Oh, hang on. I don't know if it's me. I don't know if it's the internet. I don't know if it's TradingView, but it seems to have frozen on me. We'll give that just a minute here. But there we go. Okay. So I would sell a 20 delta spread that was $5 wide. In this case, I would take in a credit. I should have taken a credit for that. Why didn't I credit 10, 950? I should have taken a credit of 70 cents in this case. Okay. So let's pull up a calculator here. Let's pull up a spreadsheet. I would take in a credit of 70 cents on a $5 wide spread. So 70 on a $5 wide spread means $5 minus the credit you took in. That is your total risk in the trade is $4.30. Now, one thing you'll notice right off the bat is that this is the opposite of what I wanted. This divided by this is, yeah, you want to know why Chris blew up his account multiple times? This is why. Because it had 6 times more risk than I could ever make in the trade. When I tell you guys that when I blew up my account, I had an 84% win rate, but when I would lose, it'd be 6, 8, 12, 10x what I would win. This is a perfect example. This is exactly what I did. 70 cents. Oh, awesome. But $4.30 in risk. But you know, it's the 20 delta put spread. So I got an 80% probability of profit. But if I get it wrong, I now need 6 trades to get back to break even. But it gets even worse because the people I initially learned to trade from would say, hey, if you're going to do this, you want to take 50% of the actual max you could win, which is 35 cents. You still have the exact same risk in the trade, 430. And what that means to you is you went from having the risk to return ratio be 6 to 1 to now your risk to return ratio is 12 to 1. This is exactly what there are people on the internet trying to teach you as the safest way to trade, as the easiest way to trade. They break the golden rule of leverage. Never put yourself in a situation where you can lose more than you can make. This is exactly that situation, and I put myself in it all the time. But you know what? It's going to expire today. Now, the best story that I can give for you is I used to do this. And then like on Fridays, I just go to the movies and stuff, right? I remember specifically watching the It movie, whatever year that was, 2017, the It movie in the movie theaters, and looking at my account on my phone and watching it was minute by minute by minute by minute. I was losing money because it was not only was this trade a loser, but it was a full loser, meaning that I was going to lose all $430 on that trade per one lot. And I'm in the movie theater and I'm like, I can't believe this sucks so bad. Right? I don't want that to happen to you. Do not break the golden rule of leverage. Never put yourself in a situation where you can lose more than you can make. And on a 0 DTE option, it's binary. It's either you win or you lose. There's nothing else you can do about it. If the Outlier 9 is all green, does that mean the stock is over the 10, 20, 50? Yes, because that is one of the Outlier 9. In fact, we'll pull up the SPY. So the trend is marked by this, the trend of the market. And then if we were to go into a stock, the stock's trend is listed right here. So it is one of the 9. In fact, let me do what's a cake? The Cheesecake Factory is a terrible stock right now. So the market's trend is one of the 9, and then the stock's trend is another one of the 9. I think my internet's going really slow. I don't know if I'm choppy or what, but there we go. And so that'll tell you if both of these are, oh, it's because it's loading all instead of just 3 months. When you change views, it changes how fast the platform loads. So if you do 3-month views, it'll load a lot snappier than all because it has a lot of data to pull to get to the all point. But anyway, like right here, the trend is down on the stock and the trend is down on the market. So both of those will not light up green in the Outlier 9. Great question. Darren says, when putting on a put, do you wait for a failed rally into a moving average and put it on at the rejection. I know you don't do puts. Okay, I get what you're saying here. Are you waiting for the pullback? Right, let's go to cake. Let's go to cake. So in this case, what Darren's asking is, hey, rather than putting the put on anywhere over here, are you waiting for a time to put on maybe like right here? The choice is yours, right? The choice is yours. There have been a lot of people who have lost a lot of money because they, or lost out, I should say, on a lot of money because they were waiting for the pullback to come, right? Imagine rather than buying it here at 49, you're waiting down here at 43. There's $6 in put gains you could have made already, waiting for it to come back up, if it ever comes back up. We don't know if it will. This reminds me of a story in How to Trade in Stock. Did not mean to throw that. This book here, How to Make Money in Stocks. There's a story in this book about a and we're live. There's a story in this book about a turkey hunter. So he's got one turkey in his trap, and he's like, oh, hang on, I don't want to do that. And then some more turkeys come up to the trap. Oh, I don't want to do that. Hang on, I see some more turkeys, right? And another turkey comes up, right? And at one point, he's got a dozen turkeys in his trap, but he doesn't actually trip the trap, right? It's one of those box traps, you know, something from a cartoon. And then one by one, the turkeys start leaving. And he's like, well, it's fine. They'll come back. They came here once, they'll come back again. And by the time that he pulls his trap, it's the one turkey that's left. And what I'm trying to say here is that if you wait, you may have nothing to make money on. But if you get in the trend at any point in time, it's already trending down. Does that mean it will continue to trend down forever? No, but at least you'll be in the midst of a trend. Same thing going up, right? You can wait for it to pull back and then get in, or you can just get in as it's trending up, right? Because, for example, let's say that you were waiting for a situation like this to occur, but you didn't start looking until here, right? You saw this pullback and you saw it launch, and you're like, okay, cool. I'll wait for the next time that happens. And you wait and you wait and you wait and you wait and you wait, and you finally see it right here. And you're like, all right, fine. Finally, I can get into the trade. Yes, let's go. Last time this happened, it ran $25 or whatever. And then it's over. You made no money in the trade, even though you could have gotten on any single one of these candles. You had chosen to wait for the pullback, and then nothing happened. And you potentially even lost money in that trade. It's a good question, though. What is the main signal now to get back into the market? What indicators are you looking at to start buying again? This is easy, right? And when you have a plan, this becomes so stinking easy. So every day in our trading room, we go through these 4 plans. We go through plan M, A, ETF, and sit in cash. And all 4 of them have an expectancy, which makes life so much easier. Now, plans M and A are our aggressive plans, and they start with the market. All you got to do is listen to the market. You don't have to try and predict. You don't have to try and say, this is the bottom. Listen to what the market's telling you. This is exactly what you need to see. First, the SPY having a bullish trend, right? Remember, what that looks like is your 10 EMA going over your 20 EMA and price going over your 50 EMA. I don't know when that's going to be, and neither do you. So all we can do is wait and watch. Second, a SPY buy signal and outlier, right? Right now, the SPY's buy signal came on November 14th, which is this candle here. And we don't know when it's going to come back, but we do know at some point in time, we'll get a buy signal and we'll have a bullish trend. So that'd be a great start. Next, the SPY fear and greed heat map. When you go into the SPY, it'll actually show you if people are getting more greedy or more fearful. What do you think we want to see? Do you think we want to see people getting more fearful in the market? Of course not. We want to see people getting more and more greedy, right? And right now, they're getting more and more fearful with the fear level down at 56. What we want to see is it growing, but be under 70. Because once it goes over 70, trades get a lot harder to make because people are so greedy that there's not enough people to help boost the greed up higher. Once there's enough greedy people in there, all those greedy people are going to start turning fearful. Then lastly, the full stock's breadth. We talked about that just a few minutes ago. But what we want to see is more and more buy signals coming through, like over here, and less sell signals. Now, you can also throw a couple other things on top of it too. Like you want to see more and more uptrends, less and less downtrends, things like that. And we don't have that environment today. We have more and more sell signals, less uptrends, and more downtrends. I'm going to take one more question, and that's going to wrap it for today. Valley Timber. The 10, 20, 50 EMA looks different on different charts. What time frame do you use for sell signals? So the 10, 20, 50 works on all time frames, period, full stop, no matter what. Reason being is it's math. Your 10 period is your short term, your 20 period is your intermediate term, and your 50 period is your long term. Now we can pull up. In fact, let's do this. Let's pull up 4 different charts. Okay, let's do SPY on all 4 of them, but we're going to do different time frames. So over here is daily. Over here, we're going to do 5-minute. Okay. Over here, we're going to do weekly, SPY weekly. Change that to weekly. Yep, that's already on weekly. And then over here, we're going to do SPY on 1 minute. How's that sound? SPY 1 minute. 1 minute. There we go. Now, what you'll notice here is when the market's trending down on the 1 minute, it could be still within an uptrend on the daily. Or if it's trending down on the daily, it could still be within an uptrend on the weekly. We see this, right? Or if it's trending down on the 5-minute, it might be trending up on the 1 minute. All of these are what's called fractal, right? You can zoom in and see bullish trends inside of bearish trends, inside of bullish trends, inside of bearish trends, depending on how deep you zoom in. What you need to figure out is what time frame that you want to trade on. Because like I say, it always works. Your 10 being under the 20, price being under the 50 right here is a bearish trend. And like I say, trends can reverse. You want to get in on the trend as it's going down and then get an exit signal and get out of the way. Now, in this case, it opened up the next day and it looks like it's starting to trend right back down. Now we're looking on the 5-minute chart right there. Okay. And now it looks like it's starting to trend down as well. It's still within a longer term downtrend. And then we go to the weekly here and we can see the 1 minute chart's trending down, the 5-minute chart's trending down, the daily chart's trending down, but on the weekly it's still trending up. Well, Chris, that doesn't make any sense. How can it be trending up on the weekly and not on the dailies? You need to figure out what time frame you want to trade. If you trade on the weekly charts, then all of this is noise. It means nothing. If you trade on the daily charts, all of this is noise. It means nothing. If you trade on the 1 minute charts, everything else is noise. It means nothing. Come up with whatever plan you want to execute based on whatever time frame that you are comfortable with trading. I have found through lots of trial and error, I can't be a day trader. I've tried many times. I've made money. I've lost money. But at the end of the day, I decided that I would rather trade swing trading. Means, one day to 1 month, basically, or maybe even longer, depending on how long the trade works. And then I don't have to stress. All I have to do is show up in the last hour of the day, roll with my plan, and then execute the plan. And then I don't have to worry about, oh, it's 11:22 a.m. Do I need to take my trade? Oh, it's 3:57 p.m. What about the trade I put on this morning? Is it still okay? No, just look at your trade, or look at your plan, execute the plan, follow the plan, and move on. And listen, I want to give you all the plans. I want to give you everything to be successful. And the best way to do that is by getting Outlier, which is literally just 82 cents a day. Everything is included. There are no upsells. Outlier University is going on right now where we're teaching you everything step by step on how to be successful. Yesterday, we spent 2 hours talking about trading psychology. And we had a guest, the lecturer, the author of Trading in the Zone, Mark Douglas. So my actual job is to make you successful. And you better believe that I'm going to do everything that I possibly can to make sure that happens. And if you're ready to save time, make money, and start with less risk, click one of these 2 videos, and we'll definitely talk soon.